All right, well, it's just after 4 Eastern here, so we're going to go ahead and get started. Just want to say good afternoon to everyone and welcome you to our panel discussion, Rethinking the 60 and the 40 and the Next Generation of Liquid Alts, where today we have with us three panelists really at the front lines of the dynamic world of liquid alternative ETFs. I'm John Robinson. I'm the co-founder and CEO of Blueprint Investment Partners, and I'm thrilled and really privileged to be guiding today's discussion. I think today's discussion is really unique as it brings together competing products under one virtual roof, so to speak. And I think it's a rare opportunity to witness firsthand the competitive yet cooperative spirit that drives innovation and thought leadership in the sector. Our goal for today is we really have one goal, and that's to enhance awareness and foster growth within the ecosystem of liquid alt ETFs, especially in light of the evolving landscape for active ETFs, which our distinguished panelists are going to talk a lot about, I'm sure. And it's our hope that today's session provides not only a greater awareness and understanding of the diverse range of products in the space, but also highlights the similarities and key differences in the strategies employed by the three fund managers represented here today. So it's our view that these strategies are really more complementary than they are competitors. We have with us today Bob Elliott of Unlimited Funds, Corey Hoffstein of Newfound Research, and Jerry Parker of Chesapeake Capital. Guys, I just wanted to thank you for taking time out of your afternoon to be with us. So first thing I want to do is just a little bio synopsis of each one of the guests, and then we'll get into what the flight plan is for today's panel. So first we have Bob Elliott. Bob is the co-founder, CEO, and CIO of Unlimited Funds. He's a former head of Ray Dalio's research team at Bridgewater, and he was also a member of the investment committee. Bob and his team manage the Unlimited HFND Multi-Strategy Return Tracker ETF, and that's ticker HFND. Corey Hoffstein is the co-founder and CIO of Newfound Research, where he leads the team behind both the RSBT and RSST ETFs, and that's the return stacked bonds and managed futures and return stacked equities and managed futures ETFs. And Jerry Parker, who joins us from down under. Good morning, Jerry. Thanks for getting up with us this morning or this afternoon for us. Jerry's the CEO and co-founder of Chesapeake Capital and portfolio manager of the Blueprint Chesapeake Multi-Asset Trend ETF, that's ticker TFPN. And Jerry was also, for those of the probably few of you that don't know, Jerry was one of the original turtles and trained under legendary commodity traders Richard Dennis and Bill Eckhart. So let's get into more the general questions here. So the topic at hand. It seems like right now we have a perfect storm of regulatory changes, recent struggles in the traditional 60-40 portfolio, notwithstanding today, but the recent past, and fund flows being just absolutely dominated by ETFs. So, Corey, let's start with you. In your view, have those catalysts reminded investors why they have or why they should have liquid alts in their portfolios? And maybe as just a quick add-on to that, with the positive performance of liquid alts generally this year and last, are we just getting started in the space?
I absolutely think we're just getting started. I'll let others talk to maybe some of the regulatory changes that have enabled some of the ETF innovation that we're seeing now. But from an actual product perspective and timeliness perspective, again, I think what we saw in the 2010s was an increasing convergence. I'm highly sympathetic when I work with advisors to the recognition that they're running businesses. And at the end of the day, performance does matter. They have other advisors down the street who are touting their performance. And if a US 60-40 is the cheap, best performing exposure, there's a reason advisors are going to get pressured into that. Now, 2022, I think, was a distinct wake-up call, particularly among the advisors I worked with who had very conservatively allocated clients, those clients who are in retirement that I think were battered a lot more than they expected. I think it was a real question of, are we doing the right thing? Is this naive stock bond glide path sufficient enough in an era of high inflation, and you saw the interest pick up. What we then saw was a question of, okay, we got it wrong on the way down, but if we mistime this and add alts now, are we going to get it wrong in the rebound?
Yep.
And so I think to the credit of a lot of advisors who I know were evaluating alts second half of last year, a lot of them were slow in the adoption, and they're still being slow and thoughtful. And I definitely encourage that, because suddenly going from a strategic stock bond mix to the incorporation of a huge amount of alternatives is a sudden, very large timing decision. And I think all of us, again, that's another thing most people can agree on, is like very large, substantial portfolio timing decisions are not normally a great thing to do, particularly if you don't have a timing view. And so what we're starting to see with our clients is the small, periodic, almost dollar cost averaging introduction of alternatives, and building that position strategically for their clients with the expectation of holding it for the next decade, with the view that the 2010s may end up being the most anomalous decade of any of our careers. And even just a return to normalcy would demand more diversification in the portfolio than was necessary in the 2010s. So we're definitely seeing it. We're definitely seeing the uptick in interest. Credit and kudos to advisors, though. I think they're being thoughtful and patient about how they're incorporating it.
Yeah, I think that's a good point. We're experiencing the same feedback, from advisors in that regard. Jerry, how about you? When you think about the 60-40, its struggles, you think about fund flows to ETFs versus mutual funds in a big way. Thinking about those catalysts, do you think that investors have been reminded why they have liquid alts in their portfolio, or do you think that if they don't, that they're now coming around to feeling like they should?
Well, I think that the way I look at it is these markets, these core holdings can go down, and we saw that. And this is how CTAs did so well last year, being short the bonds and short the stocks. And I think giving people this ability to get into something that's pretty different, that they didn't even know that they needed or they wanted, this ability to recognize that all of these markets at some point in time, stocks and bonds included, they're no different. They're not special. I know people think they are. I get that, but they're not. Trust me. They need stop losses. They need trailing stops. There's a right time and a wrong time. You have to get back in. When are you going to get back in if you get out? This is a very elementary question for trend following. And so I think creating a product like this that allows people to say, I like adding alternatives to my stocks and bonds, but what happens if I sort of turn the stocks and bonds into alternatives where they can go short as well, and then they can use this trend following approach that works so well with the alternative piece, with the currencies and commodities. So I think this is what we're trying to do, is let people see that there's an eternal weakness in anything that's 60-40 or buy and hold, in the sense that it's going to really cause problems for the whole portfolio sometimes, and you can't dodge it, and that you won't allocate enough to alternative or to CTAs in order to prevent that from happening. And then, of course, there are times where there's big trend following fails. We've seen that many times where basically the stocks crash, CTAs get short late, and it's a V bottom, and it rallies right back, like during 2020 and other periods. So trend following is going to have its own issues as well. And this is what we try to do, is educate the clients to become kind of lovers of trend following, understanding the benefits of massive diversification, longs and shorts, and using a trend following approach, and understanding when it's not going to do well, and trying our best to get people to not have FOMO, like, when stocks do really well and trend following suffers, why am I even in this product? So I think adding equities and adding some trend following exposure to the equities could help people hang on a bit longer to something that they know they should do, but there are tremendous pressures to not do the right thing.
Yeah, I think I've heard you in the past say that trend following is far from perfect, but it's good enough. And so I think you're speaking to that a little bit there. Bob, how about you? What are you, with those catalysts, what are you seeing from investors in terms of how they're approaching liquid alts right now, and maybe also address the question of, given the recent performance and the recent flows, do you feel like we're just getting started as well?
Yeah, well, when I talk to advisors, I think the 60/40 is certainly not dead or some derivation thereof for most advisors. It is the benchmark or foundational portfolio for a variety of different reasons. One, because it sort of is structurally something that has been compelling for many decades, and two, we have to recognize that there's elements of pure risk that exist in that business. And someone said, these folks are running a business, which we have to appreciate, which I absolutely do. And so I think the question from their seat is, where are there good bang for the buck opportunities to help improve, diversification without taking on too much peer risk, right? Because that's a real thing that they have to take into consideration for their client base. And so when, at some level, it's a pretty straightforward set of thoughts. There's three assets in the world, three return streams that would meaningfully improve the return relative to the risk that a portfolio manager is taking on. And that's gold, diversified commodities, and low-cost alpha strategies. Those are the three things that you can add to your portfolio that will help meaningfully. And so as a simple example, if you added, gold, there's obviously easy ways to do that. Diversified commodities, there's easy ways to do that. Diversified, what I call sort of diversified alpha or balanced alpha, which are, low cost structure, it's trend following, the variety of different trend following strategies. It's other alphas that maybe come from equity long short or fixed income alphas, things like that. If you were to take 10%, you take your 60/40 portfolio, put 10% in gold, 10% in commodities, and 10% in diversified or balanced alpha, you can get a 50% improvement. If you just look back through time, it's a 50% improvement in the Sharpe ratio of your portfolio, but you're still maintaining something like, above 90% monthly correlation to the 60/40 portfolio. That's a pretty compelling story, right? That's the sort of story that if you're an advisor, you're getting a better bang for the buck, you're getting better diversification, you're getting lower drawdowns from a likelihood perspective, but you're not taking on that business risk. And so when I'm talking to advisors, that's the conversation I'm having, which is, how do you make the first moves in that direction to help improve the diversification and the consistency without taking on too much risk? And I think many advisors find that very compelling. And look, if you look over the past 18 months, really since the Fed started tightening, there are only three assets that are up since the Fed started tightening. And what are those? Gold, diversified commodities, and hedge funds, hedge fund style strategies, right? Balanced alpha. Those are the three assets that are up. So then the question I think then becomes, how do you leg into those in the way Corey talked about? I think that's a really important point. Doing that thoughtfully. It's not a day one choice. And how do you construct those? How do you find those good managers, low cost, balanced, particularly in the alpha side of things? How do you create balanced alpha so that you're not too overweight, equity alpha or trend alpha? But how do you create that balance between them so that you can create return consistency in your alpha that's better than each one of the pieces alone?
Yeah, let's stay on that thread. I'm going to swing it back to you, Jerry, of improving the diversification of the 60/40 to Bob's point. So, clearly the 60/40 over the past 18 months, has not performed well given the macro environment versus the past, say, 30 years, and maybe even longer than that. And there's multiple reasons for this, but how does your strategy both address the challenges that a traditional 60/40 has, and how might it go about improving the diversification of that portfolio?
Oh, well, simply just by using trend following on as many markets as possible. One great thing about trend following, when you list the markets that can be in a portfolio, it's a short list because the assumption always is, well, it's buy and hold. And so we could include gold because over time it has gone up. I think at one point, Bitcoin was includable because it had gone up. Well, trend following, you can put almost all the assets in a portfolio, liquid diversifying assets. And if you wrap trend following around it, miraculously, they all become profitable. There's no more 4% of the stocks making all the money. Now there's 5 to 10% of the trades in all of the markets that on an annual basis that make all the money, because trend following is making most of the money on the outlier trades. But it converts all of these seemingly unacceptable markets that buy and hold have never had any reason to be in a portfolio. It adds to the diversification by including those in the portfolio, and they're all profit contributors over time from a trend following philosophical point of view. Even if historically they haven't made profits like cocoa, I think it's a negative over the past 50 years. That doesn't necessarily mean that the future won't be somewhat different. The trend followers, even though they're somewhat always talking about their back test and very reliant upon back test and research and computers, I think the best idea for them is to not take that history too seriously. So what has worked in the past may not work in the future. We may see things we've never seen before. We saw a big fail in 60-40. We may never see another one. I don't think our product or our trend following strategy gives a crap about that. I mean, is 60-40 dead or not? I could care less. the trading 300 to 400 markets, lots of currencies, commodities, stocks, and bonds, long and short, with trailing stops and stop losses and trend following strategy is going to be superior over time in the future. Compliance just cut that out, but in our opinion, when I got started into the business, it wasn't that, and it lasted for a long, long time. The marketing strategy until I would say 2010, we would always part of our deck would always show CTA trend following made more money than the S&P, and of course, it had a better risk control with all the markets and the shorts. And I think we're going to get back to that eventually. This has been an anomaly with this Fed policies, and I think hopefully we can get back to that, to where you do get rewarded for this approach that maximizes the potential for profit, and at the same time, there's no, it doesn't do anything to hinder the risk control as well.
Yeah, I think compliance might end up cutting a lot out of this, Jerry, but that's okay. Well, Bob, I'm going to blame you for starting this whole thread, and I'm going to come back to you and ask you a different question, which is, in your eyes, what is and I know you said that, the traditional 60-40 is an anchor. It's a mainstay in your view, right? For advisors, for all kinds of reasons. But to the extent that advisors are changing on that or softening up to it, what does the new 60-40 look like from your perspective? Maybe said another way, if you were building a 60-40 today from scratch, seeking to deliver a similar risk return profile, what are the necessary ingredients?
Yeah, well, I think part of actually what inspired me to get into this business of trying to make sophisticated, hedge fund style strategies available for every investor was actually looking at the most sophisticated institutional investors that are out there. And when you look at them, what you see, these are folks that I worked with at Bridgewater that were those clients. And they have, sufficient capital to basically invest in any assets that they want in the world and construct whatever portfolio they want, right? They're totally unconstrained. And I think what you look at is you look at their portfolio, and basically what they've got is they've got about half of their portfolio in a diversified, liquid markets set of, assets. So things like stocks, bonds, commodities, depending on the place, gold, things like that. And they have about 50% of their assets in what sort of would be classically termed as alternatives. But I think the thing that and amongst those alternatives, they have typically about 20% of their overall portfolio in diversified alpha is probably the best way to describe it in one form or another, and about 30% of their portfolio in various equity and credit-like exposures like private equity, venture capital, private credit, et cetera. And so you think about that portfolio, you basically say, well, if the most sophisticated investors in the world are building that portfolio because that's the most efficient portfolio to preserve wealth over the long term, how do we help get investors to that portfolio? Because that's a great portfolio. That's what you want. And I think the key thing to keep in mind, in addition, is they're not just building that portfolio, but they're actually building that portfolio at a very low cost. And the reason why that is, it's both highly diversified and low cost, is that what they do for each one of those buckets, particularly, on the public side, they're basically investing they're internally often managing public exposures, just buying the stocks themselves, which is essentially, very, very low cost because they're basically internalizing it. And on the private side, on that alt side of the portfolio, what they're doing is they're investing in a bunch of managers and beating them down on fees. Like, to put it very bluntly, I look at some of these big sophisticated investors, and they're not paying 2 and 20, they're paying 50, 75 basis points in 10. Like, they are cutting the fee down hugely. And when you look at those strategies, right, and you cut the fees in half, or they're a third of the fees, those are totally different types of opportunities than when you pay rack rate 2 and 20, or for most people, worse than 2 and 20, right? Most advisors and advisor-directed retail folks are paying worse than 2 and 20 on those strategies, but the institutions are paying much, much less. And the other thing they're doing is investing in a diversified portfolio. A big sovereign wealth fund might invest in 50 hedge funds. Think about that, 50 hedge funds balanced over a wide range of strategies, because they know that in certain parts of the economic environment, some strategies do better, and other times other strategies do better. And so they create a diverse portfolio of alphas, right? And so what are they doing? They're basically bringing 2 and 20 low cost 2 and 20 indexation to their portfolios, which is totally change. It's not rocket science. It's not magic what they're doing to create a more consistent, better return. It's the simple fundamental building blocks of how you create good portfolios, which is you're diversified, you're balanced, and you're low cost, right? And so that's where we're going, right? Giving people, advisors, the tools to be able to bring that set of concepts, which is, whether it's in hedge fund style strategies, whether it's, eventually in things like private equity and venture capital type replications that give advisors that similar exposure, but at a much lower fee structure and much more liquid sort of opportunities. Like, that's where we're going. And so I think that's what's really exciting about these products in the sort of liquid alt space, is they're bringing institutional quality asset management and portfolios to people at low cost. And that over time will deliver a much better return, much more consistent return for those everyday investors than they've ever had the opportunity to do before.
Yeah, I think that's right on, and that's why it's so important to do panels like this, to widen the ecosystem and to fill the ecosystem, so to speak. So thank you for that. Jerry, I'm going to come back to you and talk about, it's really in the spirit of diversification, but I know a little bit about your strategy. And I know that it's, about half the markets are, or the positions are equities, and the remaining positions are in futures. And those equities are usually comprised of single stocks versus the index. So can you talk about some of the characteristics of what you're looking for that equity exposure, and maybe why single stocks? And do you find that the single stock doing it like that, do you find that actually increases your equity beta risk?
Probably does increase it a bit on, certainly on certain days or weeks or months, all the stocks go up and down. But I think now we get more diversification from our equities than we do into the other sectors. We spend a lot of time in the past few years being long dollar, no shorts virtually. Certainly last year or the year before, short the interest rates, no longs at all. And now stocks for the past few years during that same period, not too difficult to go out and put together a portfolio trying to seek out diversification, different types of stocks and companies doing different things. A lot of ours are commodity related. That you get a lot of diversification. There's a lot of longs, a lot of shorts, and the markets all look very different from the S&P. So I think sometimes that's not always going to be the case. Right before COVID, we were long every stock, long every market pretty much, and they all crashed. So you really can't predict over those short period of times that we don't try to have the perfect portfolio all the time. We just follow the trends. We're not always going to be positioned correctly based upon the next shock event. But I do think that, like I said, the stocks deserve to be 50%. And that's why they're 50%, because the amount of diversification they can give us. Sometimes I do wish they were more correlated to the S&P or those big 7 stocks, but they're not. Probably if you get away from the big 7, the rest, the 493 are not that correlated to the S&P. So we try to stick with the smaller mid-cap type companies that give us some indication that there will be a bit different, and they'll be more like commodity. We want to kind of commoditize the stocks, where if you looked at a chart, looked at the data, you wouldn't even know if it was a currency, a commodity, or a stock.
Mm-hmm. Well, before we move into the audience Q&A, Corey, I wanted to circle back to you on something that you said earlier that I wrote down and I just can't get it out of my mind. So, it's better to ask forgiveness and permission. So I want to ask you this because I think it's on the minds of everybody in the audience, at least most people. And that's this issue of, okay, an advisor decides, all right, I need to have this liquid alt exposure, and now they're confronted with a timing decision. Can you just talk a little bit about, and you have already, but maybe expound on, like, okay, they're confronted with the timing decision. How do you help them? How do you walk down the path with them? And what are some things within that process that you've seen help?
Yeah. And I think this is one of the big problems that a lot of advisors face, right? When they are looking to do this. So first and foremost, what you tend to find is advisors often, and I don't want to say advisors, this is all investors, institutions as well. They start looking for product near the point of maximum pain, right? You often don't know you need managed futures until you watch your stocks and bonds go down. And then you start hearing, oh, managed futures are up 30% on the year. And it's often point of max pain that you go, okay, I need to do something different. Kudos to those who make the move beforehand. In my experience, it's rare. There is a degree of performance chasing. That said, most are very aware that they are inherently performance chasing. And the fear again becomes, especially when you have to do the diversification as a process of addition through subtraction. Okay, I'm performance chasing into a diversifier, which means I need to sell the things that have just gone down the most. I'm selling my stocks and bonds to move into this thing that's up. Did I get the timing wrong in two ways? Not only that I missed it already, but I'm going to miss it in the other direction. And so again, my advocacy for all of these people is to just think about how you would tell a client to do this, right? If a client comes into a large sum of money, is the idea that they should throw it all into the market at once? Should they dollar cost average into the market? A lot of those same ideas apply when making large structural portfolio changes. If you make a change today versus at the bottom of March 2020 versus at the bottom of November last year, those same portfolio changes can lead to very different material performance impacts, permanent performance impacts. And the same way we diversify across markets, the way Jerry's been talking about this, and Bob's been talking about diversifying across different asset classes and exposures, you can diversify over time. And it's the same thing everyone always advocates for their clients, is just dollar cost averaging. That's what diversification over time means. And if you want to limit the impact of when you make that decision, that's what you need to do. Now, I understand operationally that is more frustrating for advisors, particularly if you don't have good rebalancing tools. But if you do happen to have good rebalancing tools, it can be as simple as saying, I'm going to build this position into my portfolio or, build a sleeve of diversifiers into my portfolio over the next year. And I might do a little bit every month, or I might do a little bit every quarter. But in doing so, you can really dramatically reduce the impact of that timing decision. Now, I'm going to go completely off script here because I do want to give kudos to Jerry, who has been a long-term trend follower and a big inspiration of mine in the trend following space. One of the things I hear all the time is people who struggle to do due diligence on trend followers. One of the things I would really urge people to do if you're on this call or listening later is look up the performance of different trend following strategies today. And I think looking at days like today where you have really extreme moves in equities, bonds, the dollar has been a big driver for managed future strategies. So just something that I would throw out there as someone who evaluates a lot of funds as an ETF strategist. Days like today can be really instrumental in understanding the difference in drivers between different funds.
Yeah, I think that's a great point. And the nerd in me wants to run down that path as fast as possible, but we have to stay disciplined. And that was great, guys. We're going to move into just with the balance of our time, maybe 12, 13 minutes. We've pulled out. Thank you to the audience for sending so many questions. There's no way we're going to get to maybe even 5% of the questions. But again, I want to remind you that the contact information for everybody on this panel is in the chat box. Feel free to grab that before you go and reach out to each of the respective panel members or a member of their team, and I'm sure you can get your question answered. So somebody has given me the job of deciding who the question goes to, and that unwise person will remain nameless, but I'm going to pass this to you, Bob. So here's a question. What expectations should investors or prospective investors in your strategies have relative to interest rate environment changes and or equity market volatility?
Oh, that's a good question. I think one of the things that's interesting about some of the work that we're doing here is at least for some of the work that we're doing with our strategy, as well as the managed futures that are included in Corey's strategy, is essentially what's happening is we're indexing alpha. Now, that's an interesting point, right? Indexing alpha is not on the surface obviously intuitive what that means, but essentially what it is instead of adding idiosyncratic manager positioning risk, which could be good, like what Jerry brings to the table, or bad, like what others bring to the table, right? What it allows you to do is to start to think about the consistency of that return relative to macroeconomic factors. Now, if I told you certain things were going to happen in the macroeconomy around stocks, around bond, you'd sort of know, like if inflation happens in a certain way or growth happens in a certain way or monetary policy, you could probably, if you've been in the markets long enough, sort of quickly recognize this is what happens to stocks, this is what happens to bonds. The same thing can be done for alphas, and that's one of the benefits of thinking about indexing alphas, is that when you index them, you can start to think about the return properties. Managed futures does particularly well in certain environments, right? Late cycle tightening environments, and not as well in other certain environments. For instance, early cycle, high easing environments, typically equity and event-oriented alphas do better. Now, that's really important to think about, because you can start to think about then, how do I balance that portfolio, right? So that I have late cycle alphas, particularly like managed futures are very good late cycle alphas, uniquely good late cycle alphas, with early cycle alphas to create a balanced set of alphas that create a more consistent return stream over time. And so that's a really important, and creates alpha through the cycle rather than alpha concentrated early in the cycle or just late in the cycle. And that's the sort of thing that you can do. So when I talk about interest rate risk or equity risk or volatility or all those different points, part of the real benefit is transitioning away from this individual manager and the idiosyncrasies of that, like in a hedge fund space, like what's the confidence interval of a single manager in 1 year? It's like -20 to +20. Like who the hell knows what that is, right? That's not a return stream. That's a gamble, right? But indexation changes the picture and allows you to think about these as return streams, just as they are like bonds or a return stream, or stocks or commodities or gold are just return streams. And so that's what I think the real advantage is in thinking about indexation related to alpha strategies.
Yeah, thank you. Jerry, I'm going to pass this to you, and I'm going to pass it to you because I think I've seen you weigh in on this on Twitter or X or whatever recently, and maybe Corey, if you feel inclined, weigh in after. So the question is, you're being asked to weigh in on the Sharpe ratio, and as an analyst, portfolio manager, CIO, looking at metrics and return data, what are your thoughts about the Sharpe ratio as a relevant metric to be used when looking at your specific strategy?
Well, I think it's not a good measurement for our strategy because we are doing the old-fashioned trend following thing of letting profits run and not reducing exposure in sugar, cocoa, orange juice, yen, bonds based upon volatility and correlation. Once it turns into a profit, we become very bold with that and we hang on to it irrespective of the increase in volatility. So I don't think, and so we'll be punished for that increase in volatility, and that's why we don't like it. Our goal is to preserve the capital in the account, the contributions to the clients make, and the realized profits and losses. And we have that little nest egg, and we're very careful with it. We're going to protect it. We're going to take these small losses. And then this is going to allow us to be crazy bold with maximizing the profit and allow us to be in a situation where we can really, not only do we have rules, we can actually follow those rules because we don't have to worry on a day like today where all the profit give back, it's painful, but it's all open profit. And so that doesn't mean anything to pretty much anybody but me, but it's a great little algorithm we have that allows us to maximize the profits and continue to do the trades that we should do and not have to override the system trades with critical money management decisions like in days today where we'd have to reduce positions dramatically based upon this open trade profit and this volatility. So we don't really want to do that. We want to, and I don't think from a kind of risk of ruin or a risk of a certain drawdown point of view, for us, the Sharpe doesn't translate into those real concerns. And I think that's really the problem with using those particular volatility-based metrics where we're making money. We're hoping and praying for this volatility because that's going to be driving a lot of the profits.
Yeah, I think I've heard that the only thing that complains about upside vol is the Sharpe. So, Corey, same question to you.
Yeah, I mean, look, I think the Sharpe ratio is a brilliant metric in theory. In the real world, right, you have to understand that the Sharpe ratio is only going to be able to be fully descriptive of a strategy where volatility is fully descriptive of risk. When you talk about something like trend following, the way Jerry does it, trend following is going to mechanically alter the distribution of returns. You're going to have lots of tiny losses and a huge right tail of gains. And volatility is not going to be symmetric under that scenario. The skewness really matters. And so the Sharpe ratio is going to be wildly driven by how much of that upside vol you've realized in the past. And it's just not going to necessarily be a useful metric. If you look at something like asset classes, a lot of asset classes, bonds and stocks particularly, they do have reasonably symmetric volatility. Everyone will say stocks have more vol to the downside, but it's nowhere near as skewed as other asset classes. There's less skewness in most risk assets, but not like trend following really manipulates the distribution. Sharpe might be a little bit more applicable there, but for certain hedge fund strategies, Sharpe just doesn't even begin to pick up the risks or understanding what the return distribution actually is.
Well, look, we're coming up on the top of the hour. I think we're going to pause for now on this. I want to thank you guys, the three of you, for your time this afternoon. This has been a lot of fun. I want to thank the audience for not only your participation and carving out some of your afternoon to join us, but also for the great questions. So with that, I just want to thank everybody for being here. And until next time, thank you.
Thanks, John.
Thanks, everyone.